Hi guys, welcome to my channel, and remember, like, subscribe, and drop me a comment, and let's interact. And yeah, today we're going to be talking about a topic which is slightly treacherous, and yeah, it's almost like you're attempting suicide by trying to explain what this means, because a lot of people have tried and failed to explain it to people. Hopefully I won't be part of the statistic, but if I'm part of that statistic, guys, I would have tried. I'm just trying to help you out. In financial accounting 3701 or 367 1 or 2, somewhere there, you're going to come across this term which they're talking about as deferred tax. And I really advise you, please, you need to buy your textbook. Use your textbooks with this module so that at least you get a clear understanding. So I think the best one for this definition, you'd find it in descriptive accounting, depending on the version that you'll be using. And yeah, that would be pretty much what you'd find where you find deferred tax and stuff. So try to get what do you call it, get the study guide and get an understanding of what they're talking about when they're talking about deferred tax. But in my own opinion, when they're dealing or they're talking about deferred tax, it's almost like a futuristic tax. So for some odd reason, I don't know, the moment you say deferred, you always think it is easier for your mind to quickly give you what do you call it, deferred, something that you haven't paid before, or something that is like behind you or something like that. But in the sense of financial accounting, what I've come to realize is deferred tax, they're calling it, it's almost like a futuristic tax. Okay, a futuristic tax. So you're going to have what they call a carrying amount of an asset or an item. At the same time, you're going to have a tax base of it. So before you can even get that far, one thing you have to understand is with this financial accounting, what is happening is, in my own opinion, it's like we are having two what can I call it, two bodies which are trying to have a fight with each other. One is IFRS, right? That is the way we do accounting, International Financial Framework of Reporting Standards and wada. This is the international, the FAC standard. Then we have the Income Tax Act, right? So these two things are a bit, they are not the same thing. So what we can call a profit in accounting might not necessarily be what the taxable income is going to be talking about, because the taxable income is going to be talking to you about stuff like items which are supposed to be deductible, items which are not supposed to be deductible. This side, we might have a gross profit minus operating expenses, we get operating profit. So the fight between those two frameworks, that's where issues like deferred tax arise from. So the goal is, at the end of the day, you have to pay the correct amount of tax, and the correct amount of tax includes the current taxation and a portion of deferred tax. So what is this deferred tax? So basically, in my own opinion, it's a futuristic tax which arises from differences between your carrying amount and your tax base. So just to put it in a very simplified manner, a tax base is the value of something according to SARS, or the value of an asset or liability according to SARS. SARS being the South African Revenue Services, right? According to tax, the tax base, SARS is saying your vehicle, SARS is saying your machine, your building is worth so much. According to financial accounting, your carrying amount is going to be your cost minus your depreciation. So if these two principles are like going at each other, they are saying, according to the financial statement way of calculating deferred tax, of course, you are going to have a carrying amount which is according to FAC, and your tax base which is according to SARS. The difference between the two, that is where deferred tax is attracted from. How to calculate tax base is something that you have to also go study. This video is not about that. When I find time, I'll make a video about tax bases and stuff. But just in a nutshell, it's a carrying amount of an item according to SARS. That's tax base according to the Income Tax Act. If I just say SARS, you might get confused. According to the Income Tax Act, we are saying this is worth so much according to the Income Tax Act, which is amended every now and again, the 31st of March, taxation, blah, blah, blah. You know the story. So we want to get a point where we can pay the correct amount of tax, meaning we now have to apply the rules of this, which is the Income Tax Act, and try to also cancel some of the rules that are applied on on IFRS. For instance, what I mean by saying that, I mean if you're having a fine is regarded as an expense according to IFRS. According to the Income Tax Act, they look at you and say, how can you be deducting a fine? You are supposed to actually do the right thing and not attract a fine in the first place, meaning you have to add back. So basically, there's going to be a lot of backing and forth between the two. But in order for you to understand it quicker, just look at it as if there are two frameworks and you are trying to reconcile the two frameworks so that at the end of the day, a person pays the correct amount of income tax. So with deferred tax, what they then say is, if you are going to be saying, let's say your vehicle is going to be 80,000, then it's going to be worth 80,000. That's the tax base according to SARS. How they got there? Probably they say it cost. Then they are going to say 20% off, 15% off. Usually the question will tell you. They're going to say, okay, according to SARS, we depreciate vehicles at, let's say 20%. Right? So you have a vehicle which is going to be 100,000 at first. And your policy as a business might say we depreciate our vehicles at 10%. So these guys, let's say for instance in this example, SARS is saying 80% and you are saying, your business is saying 10%. What this means is in the first year, yeah, it's going to be 100, there's no difference, so there's no deferred tax. In the next year, your carrying amount is going to be 90,000 and according to SARS, your tax base of the same vehicle is going to be 80,000 because they will be giving you something which they call an allowance. That's tax allowance, which is the 20,000, which they are saying you have to remove as a tax allowance. Meaning, according to SARS, after year one, your vehicle is worth 80,000, but you are saying your vehicle is worth 90,000. Then SARS, or the Income Tax Act, then stipulates that because in the future, when you dispose of your vehicle, when you sell it, you're most likely going to make a profit of 10,000 because now you have 90,000 and you have 80,000 on the side. So in the future, you are most likely going to make a profit of 10,000. So as you are about to make that profit of 10,000, you have to pay the tax on that profit. That's where the futuristic part comes. So the key thing that you have to understand is, okay, what is the carrying amount of the liability? What is the carrying amount of the asset? What is the carrying amount of the other thing is your, I think it's your prepaid expenses as well. What is your carrying amount of your prepaid expenses? And what does the income tax say? What is the tax base? So immediately there is a difference between the carrying amount and the tax base. We have what they call deferred tax. That is where deferred tax is coming from. So they are saying in order for you, when you sell, if it's higher, remember it's higher because it goes on to split to two. Of course, that is easier for you to understand. It is then it goes on then to split to two. We have deferred tax asset, we have deferred tax liability. So if you're, let's say in a term of an asset, if your carrying amount is going to be higher than your tax base of an asset, is going to create a deferred tax liability, meaning you have to pay, you are liable. If it's going to be lower than your tax base, meaning you have an asset. So basically those are the rules. I think in your study guide they are clearly explained. Those rules are not so difficult, but the part that I just wanted to assist you was for you to know, okay, what is this deferred tax that these people are talking about? That's the part that this video is about. It's a futuristic tax, right? It's a futuristic tax that you're going to be paying in, you're paying it now for transactions that are going to be happening in the future. That's deferred tax according to my own understanding. So you can go on and get the cleared or the book version of it, but I hope this video assists you at least in just trying, because this is a very, very complicated subject when it comes to financial accounting and financial reporting. Deferred tax is one of those most complicated parts, but I'm just trying to break it down for it for it to be a bit much more simpler for you. Deferred tax, we're talking about a futuristic tax, but you are paying it now because there is a possibility that you are going to make a gain in the future, you are going to make a loss in the future. So you're either going to be paying it, or it's going to deduct your tax liability at the end of the year. So guys, thank you so much for taking time to listen to what I'm saying regarding this. Remember, if it's if you're viewing this video for the sake of 3701, please remember, don't forget to disclose, right? Your disclosures are important. Your disclosures are very, very much important. If it's for 3672, please 3671, sorry, 3671, try 3761. Forgive me, I'm still trying to get my head around like the naming of those modules. Please don't forget, you have to disclose. Your disclosures are important. They are very, very important. We're going to be talking about accounting frameworks, accounting disclosures policies, where they are coming from, how we move from GAAP all the way to IFRS, a whole lot of history, right? But for the purposes and the sake of this module, you really have to know them. And yeah, I really appreciate your subscriptions. I really appreciate your comments and your likes. Thank you so much, and all the best with your forthcoming examination. Thank you.